Good morning. Good morning. I'm James Williams. I'm the Dean of the Seidman College of Business. And on behalf of Grand Valley State University, the Seidman College of Business, the Seidman Alumni Association, and indeed, Stiefel Nicholas and the CFA West Michigan Society, our partners this morning, I welcome all of you. Thank you very much for joining us. The panel discussion this morning, financial crisis and proposed regulatory reform. Does it address the problems? I know we all eagerly await the discussion. The Seidman College of Business provides a rigorous learning environment with a student focus, a regional commitment, and a global perspective. That's our mission and our mantra. And this morning, thanks to the support of our partners, we're able to bring all of those aspects together so we can talk about the financial crisis and help us all to understand what's going on and what we can do about it. So I'd like to stand aside now and invite to the podium the chairperson of the Finance Department, Dr. Sri Sundaram.
Thanks, Dean Williams. Again, good morning to everyone. We're looking forward to a wonderful discussion this morning. One of the things we've looked at as our role at the Seidman College of Business is to, when we have such occasions, to facilitate a discussion regarding important issues. Right after the financial crisis, we did one in 2008. We did a follow-up in 2009, and we thought this was the right time to do another one to look at what are some of the lessons we learned in 2008, and when we propose new reforms out there for financial institutions, do they address the issues that have contributed to the crisis? And who else other than having these four wonderful panel speakers here. So I'm looking forward to a wonderful discussion. Right now, I would like to bring forward, first of all, Mr. Ted Fugger. Many of you know Mr. Fugger. He is the portfolio manager for Calder Investment Advisors. He also belongs to the CFA West Michigan Society and has served in many roles in the investment advisory roles for many institutions, and a longtime veteran of the investment industry. Without delay, Ted, would you please come forward and say a few words?
Good morning, and thank you very much. On behalf of the CFA Society, we want to welcome you all here today, and we want to thank Dean Williams, Sri, and the entire staff of the Finance Department for helping put this discussion together. As most of you know, the CFA Charter is a global certificate of competency and ethical behavior. The CFA Institute is a leading voice of fairness, transparency, and investor protection. We have over 100,000 members worldwide, operating in 67 countries. The objectives of the CFA Institute, which include fairness, transparency, and investor protection, are accomplished by working with the SEC, FASB, Congress, and international regulators to facilitate transparency and understanding in the financial markets. CFA West Michigan promotes these goals by working with capital market participants, with universities, and the media to promote understanding and awareness of financial issues. We believe that the current accounting complexities, lack of accountability in the rating system, political gerrymandering of Fannie and Freddie have made it very difficult for the investor, whether it be an institution or a private investor, to understand what the risk is for the potential investment that's being considered. We believe that derivative products, which will be addressed today, also contribute to this problem. Very simply, we believe that financial statements and financial instruments should enable all the investors that use these instruments and look at them to further their financial goals. It should provide a reasonable way of evaluating the risk in the proposed investment. We do not think that these conditions exist today. And the reasons that we do not believe that these conditions exist today will be addressed by our panelists. Again, thank you all for coming, and thank you, Sri, for putting this together.
And I should say, Ted was one of the key persons instrumental in thinking about this panel session and bringing the speakers here today. So thanks again, Ted, for giving us the opportunity to work with you. Right now, I would like to take the opportunity to introduce our panel members to you. I would like to say a few words about the format of the discussion this morning. Our goal is to facilitate the presentation from our speakers first. After my introduction, the speakers will talk about, will present their content. We have a few slides from each of the speakers. And we also have a couple of people that will be providing you with index cards. If you have any questions, please put them down, and they will collect them from you and pass it on to me so I can ask the questions to the speakers so everybody can hear that. And so please keep in mind, so as you see, think of an idea, if you want to put it in a paper, or if you have our student aides that will be walking next to you, please feel free to collect the index cards and write on those index cards. Now, without first, I'd like to introduce my colleague here, Dan Gediman, Professor Dan Gediman. Dan and I have something in common. We both come from the Saluki land. I don't know how many of you know what a Saluki is. It is an Egyptian dog. We went to school at Southern Illinois University in Carbondale. Then Dan did his PhD at Washington University in St. Louis. Dan is a historian from a banking, and so you will get a historical perspective. And I did get a hard time when I said brief historical perspective because he does have only a few minutes. So we professors tend to be very long. But as always, Dan has a very interesting perspective and wants to give a different perspective about what some of the roots of the crisis were and what we could have learned from it. And again, please help me in welcoming Dan Gediman, ladies and gentlemen.
So Sridhar said that I will give a historical perspective. I guess I'll go back and name a few dates. 1785, 1792, 1819, 1837, 1857, 1873, 1893, 1907, 1929. All those were previous financial panics. So what we've experienced over the past 2 years is nothing new for the United States. As a matter of fact, what's probably unusual is the fact that from 1929 up until 2007, we didn't have a large financial panic. We had several incidents, long-term capital management, the savings and loan crisis, and things like this. But overall, the system worked pretty well. And some economists refer to that as the quiet period in banking. And I guess a question that we wanted to know is, will this quiet period come back, or was that just sort of an aberration that happened over those 70 years or so? A few years ago, it reminds me, back in, say, 2003, 2004, I was lecturing with my money in banking class, and very, very surprisingly, a student kind of indicated that this class wasn't that most interesting. It was a little bit boring, and I was surprised that economics could ever be boring. But I mentioned to the student, I said, banking is supposed to be boring. If banking ever becomes interesting, we have problems. We haven't had to worry about the class being boring for the past 2 years. So what I'd like to do a little bit real quickly is kind of explain, what is what caused the problems today, and I'll have a little bit of a different take on it than maybe what we've heard before and what we'll hear a little bit later. But what's the potential for systemic risk, lurking in the heart of the financial system, and the answer to that is the shadow banking system knows. So That was my joke. So I thought I'd go back to like, Great Depression era humor to bring us up to speed. So basically what I think has caused a lot of the problems is, this is a complicated picture, but let's kind of get at the heart of it, is that we've had a run in the financial system, and it's not a bank run like our traditional bank runs. The traditional bank runs would have been things like we watch every Christmas on It's a Wonderful Life, when people run to the Bailey's Savings and Loan and they try to pull their deposits out. That didn't happen, in part, primarily because we have deposit insurance today, the FDIC. But there was a run in the banking system, and the run in the banking system occurred in the market for repo. And the way that the repo market basically works is you have very large people with funding, and they'd like to do something with this money, and you also have very large financial institutions that want to borrow money. And so suppose I want to buy assets. I want to buy $100 million of assets. Where am I going to get the funding? Well, I need to borrow it from somebody. Nobody's going to be willing to lend me $100 million unless I provide them with some sort of collateral. So what I do is I set up some sort of arrangement where I basically say, let me borrow the money and I will give you $100 million worth of assets that you can hold basically overnight or for the next few days. And I promise that I will buy them back from you. And that's pretty much the way a lot of the large financial systems were financing their acquisition of assets. As a matter of fact, it seems as though for the large former investment banks, about half of all their funding of assets came from this repo market. How large was the market overall? There aren't clear statistics on it, but estimates are that it was about $12 trillion in terms of the repo market, compared with the traditional banking system of $10 trillion. So this was a huge market. And so basically what would happen is, you'd have the corporate borrowers and consumers come in, they would go to a bank or some sort of funding, and then basically what happened is the money would come in from, say, money market mutual funds and other types of lenders, and it would get bought through these securities products. And so the question that we're going to talk about more about security products a little bit later, but one thing that's sort of interesting is, well, if it was just the security products that were failing, how come it weren't just the end users that were having all the problems? Why were the banks failing? And the problem is that the banks were holding a lot of these products as well. Why were they holding them? They were holding them because they wanted to use them as collateral. This is all well and good as long as people believe that this collateral is worth something. What happens is, suppose that we start to believe this collateral is not worth anything. You want to borrow $100 million. I'm willing to lend you $100 million, potentially, as long as you give me $100 million in collateral. Well, suppose I think that collateral you're going to give me is not worth $100 million. Okay? Suppose I think there's some risk that it might not be worth something. Maybe it's some sort of securitization based upon subprime mortgages. Well, I might ask for a haircut, basically. Basically, what I would do is I would tell you, if you want to borrow money from me, I'll take your $100 million in assets, but I'm not going to provide you with $100 million in funding. I might provide you with only $90 million in funding, and that would be a 10% haircut. Now, what's sort of interesting with this graph is this is a graph that shows sort of the average haircuts in the repo market, and this is for securitized products. This doesn't include things like corporate bonds. Corporate bonds, there was a slight haircut that went up from 0% up until about 3%, and that happened in 2008. But if we look for the securitized products, and this is not just subprime lending, this is the average of all sorts of securitized products, and we see that it went up to close to 45%. Anytime that I ask, this is where it gets interesting, kind of relates back to where we've seen before in the past. Anytime these outside lenders ask for a haircut, it basically is essentially the same thing as a withdrawal from the banking system. And so what we can see here is there are huge amounts of withdrawals from the banking system, not very much different at all from when, back in the 1920s or early 1930s, you and I would want to pull our savings out of the banking system. And so what happened here was this huge outflow of funding from the financial system. They couldn't support itself. And this is one of the major things that led to the crisis with the financial panic. And I think that's pretty much all I want to say for right now. So.
Thank you, Dan. Thank you very much. Next, we have Mr. Harvey Corning, and I think many of you know, working with Harvey here. Harvey is a partner at Wharton Law, and Harvey received his law degree from Harvard and has been working very closely on the public and private institutions, very familiar with the securities regulation, has done a lot of work with issuances, also closely works with the banks, so has a pretty good feel for what's happening in Michigan in the banking industry, and does a lot of work with capital raising. I'm sure that has been a pretty difficult time there, Harvey. So without any further delay, the floor is yours, Harvey.
Thank you, Sri. Good morning. Good to see everybody here. I suspect we've got some college basketball fans that might have been up pretty late last night and still raring to go in the morning. That's great to see. Before we dive into regulatory reform, I thought we'd take a moment just to check on our investments this morning. You know, some people click on the computer, want to see how their investments are doing. So if we go to the next slide there, we can see that as taxpayers, we are all invested in the financial system courtesy of the TARP program. Before we had time for regulatory reform, we gave the system a shot in the arm back in late 2008 and 2009, and here's kind of how it's going. $700 billion was authorized for this program. Nobody knew quite how much it would take at the time. So far, we've put about $250 billion into commercial and investment banks, a big chunk in AIG, and also in the auto manufacturers. The auto money, we probably won't see much of that again. AIG is selling itself down. We may get some of that back. Overall, about 50% has been repaid so far. And if you look at just the banks, it's about 75%. So that's actually running ahead of schedule. The Washington Post recently described TARP as the program nobody likes, but it's still working. We could have a whole debate today about the philosophy of U.S. government direct investment in private businesses and all the consequences that flow out of that, but it was a program put together on the fly, and it at least stabilized the system for the time being till we figured out what to do next. There's definitely a sense that something ought to be done. The financial crisis we experienced was as severe as any since the Great Depression, and if you're in Washington, there's tremendous pressure to do something about it. So if I could have the next slide there. Financial system regulatory reform, just to set the stage a little bit, for me it's a little bit like healthcare reform. I know it's a huge sector of the economy. I know there are lots of complicated things going on there. You feel like there's something we could do better than what we're doing right now, but it sure is hard to put your finger on exactly what that is. A lot of that is due to the fact that there are so many contributors to the crisis and the problems we've been having in the financial system. Everything from a housing bubble to complex derivatives to securitization to the shadow banking system and the repurchase obligations and how all that works, issues with the ratings agencies, you know, the list goes on and on. And because there are so many contributors to the crisis, there's no easy magic bullet where you say, well, if only we did this, we'd be all set. If we could just fix this one little flaw in the system, we'd be okay. Even just talking about the financial services industry is a pretty broad umbrella. It's everything from the George Bailey small town community bank from It's a Wonderful Life right on up to Citigroup and the mega banks, and even things that I wouldn't really consider banks at all, more investment banks like Goldman Sachs and big financial institutions in that arena, and also other sorts of institutions like AIG, which was really more about insurance and trading and investments than it was traditional banking. Regulatory reform at this point has been a pretty long, drawn-out process that's been going on for over a year. The House of Representatives passed a reform package back in the December timeframe. Since then, it's gone to the Senate, and the Senate has its own politics, and Art will be able to help address some of that in a moment, just kind of how that process works. But it's been in the Senate Banking Committee right up until about 2 weeks ago when they finally passed a bill out of committee. It was labeled bipartisan, but it got out of committee on a straight party vote, so we'll see how it does in the full Senate. It's a complicated bill. We're going to touch on some highlights of that in a moment. It's over 1,300 pages long, which the good news is it's shorter than the Grand Rapids phone book, but it's still longer than the Bible. So that gives you a sense of just how much is in there, just in terms of sheer pages. Obviously, we're not going to cover all of that this morning, but let's switch slides here and hit a few highlights about what's in this bill anyway. I know I kind of follow politics and things, but when it comes to health care reform, I still can't explain to somebody what's in the health care reform bill. So I imagine a lot of people have that same thing with financial reform. Well, what's in there exactly? What does it do specifically? A centerpiece of the bill as it's come through Congress has been the idea of a consumer financial protection agency. Now, for years and years, we've had consumer protection laws. They're on the books, they're enforced. At least they were enforced in the traditional banking system, which are the regulated banks, the community banks that we're familiar with, and also the bigger national banks. Some institutions that were less regulated were non-bank mortgage lenders and some of the firms that were securitizing and putting these mortgages together. And the political viewpoint is, gee, if only we had better financial regulation of protection of consumers, somebody for whom that was a top priority, if we had a special agency dedicated to that, wouldn't we all be better off? Couldn't we do a better job of enforcing these laws? And there's a lot of debate in the system. I mean, if you're a community bank, you say, wait, we already answer to two or three agencies that come in and do on-site examinations, including our consumer lending compliance. Do we really need yet another agency to come in and examine us and tell us how we're doing, write rules, take enforcement action, that sort of thing? But the politics of it are such that the bills that have gone this far, and probably what will emerge, is some sort of separate consumer financial protection agency similar to the FDIC, the Federal Reserve, the Office of the Comptroller of the Currency, and the other agencies that are out there with the ability to write and enforce regulation. I think it's a legitimate question to ask at this point, you know, is the horse out of the barn already on subprime mortgage products? Is the answer really more regulation so we don't have these, or has everybody figured out already that those didn't work very well and we aren't going to experience that same thing again? So that's one aspect of the regulatory reform. Another aspect of the regulatory reform is the idea that the financial system is broad and parts of it are heavily regulated, the banks. Parts of it, like the large investment banks and some of the other institutions, the regulatory posture has been more hands-off over the years. The idea that, hey, these are very, very smart people working on Wall Street. They're very sophisticated. They manage their own risk. We don't need to be on top of Lehman Brothers the same way we're on top of Bank of America. And that's a lot of the origin of the crisis, is some highly leveraged Wall Street institutions relying on short-term funding, and they got themselves in a pickle when things went south. So the one aspect of regulatory reform is the idea that we need some sort of systemic risk oversight. We need somebody looking at the big picture, figuring out where the next risk is, where is the next AIG, where is the next Lehman Brothers, and who's going to be in charge of regulating that if no one is now. So they're going to create a super council of regulators to kind of look in the future and evaluate where the systemic risks are, what institutions are in fact too big to fail, what institutions pose a risk to our system, and then take the extraordinary action where necessary of putting a federal agency in charge of regulating them, requiring additional capital, requiring them to come up with a potential wind-down plan should something catastrophic happen. That's an aspect of the regulation I think has some potential, because there were gaps in our system about who's regulated and how, particularly for large, complicated institutions. A related concern there is the next point about how do we resolve an institution that gets in trouble. If a community bank gets in trouble, the FDIC is the agency that comes in and winds it down and liquidates it, and they have a very orderly, organized procedure for doing that. They're very good at it. It's very swift. Unlike a bankruptcy court procedure that could stretch on for months or years, the FDIC has the tools it needs to go in and resolve that organization. Part of the problem we ran into in the fall of 2008 is when they let Lehman Brothers go down, is there was no organized way to resolve it quickly and figure out where the liabilities were and kind of stem the risk to the system. It went through the bankruptcy court process, and it gets complicated, and it takes time, and it was hard to figure out where things were and what to do with them. An interesting question will be who gets that authority. Some people think, well, the FDIC does so well with banks, shouldn't the FDIC step in and take care of non-bank institutions? Whether that authority and skill set will translate over into dealing with something like a Lehman Brothers, which is very different than a community bank, remains to be seen. I think some people have some reservations about that. Another aspect of the crisis that we'll get into a little further in the program is the whole idea of securitization, bundling assets and securities together, packaging them in different ways, and then selling them off. Lots of mortgages got packaged up and were treated as higher quality instruments than they really were. What can we do about that? That's an area that may be a little more difficult to regulate. Is that something where we just need to be more careful as packagers and buyers of these instruments, or is that something where the federal government can step in and regulate? One thing you'll see as part of the reform proposals is this idea of skin in the game, kind of an eat-your-own-cooking provision that, boy, if only we had the financial institutions that package these things had to keep some of that security, they'd be a lot more careful about what they packaged and sold. To me, that's a bit of a gimmick, but that's what's in some of the packages right now and may become part of what's ultimately passed into law. Then you've got a whole nother area, which is the whole area of derivatives, credit default swaps, all kinds of other derivative instruments that were prevalent. There's nothing evil about a derivative. They're a very useful tool, but they can be highly leveraged. And a problem we ran into is they don't trade on a transparent, organized market in the same way stocks and bonds do. At least they haven't historically. Part of the financial reform legislation would go to creating more of an exchange trading structure for these instruments, also a centralized clearing process to be more organized about how these trades occur, how they clear, when the money transfer, when the risk goes over, so that if one of the parties to the instrument goes down, there's some knowledge about where everything is at. Right now, it's a very unregulated private market. Derivatives are basically private contracts. One of you and I could enter into a derivative contract and create one today. So we're going to see more regulation of how those are structured and traded. One bullet I don't have on there as well, but is another player in the crisis, is the whole ratings agencies. Where were, Standard & Poor's and Moody's? How did they rate these instruments so highly? Wasn't that a cause of the crisis? I think it was a contributing factor. A big question is whether it's something that's susceptible to regulation. Can you regulate and legislate rating agency behavior and how they operate and how they do ratings? There's a stab at that in these bills. Whether that's going to be effective or not remains to be seen. Before we pass the baton here, I'll just do one more quick slide with you to try to translate that. What does that mean for local banks? What does that mean for banks right here in Michigan? I think the effect of regulatory reform is going to be more indirect than direct. The troubles Michigan banks are experiencing are not the result of trading exotic derivatives. They're not the result of subprime lending. They're generally a result of a down economy, partly resulting from the financial crisis and the struggles faced by the borrowers. If the borrowers aren't doing well, they aren't able to repay. If they aren't able to repay, that creates loan losses. If you have loan losses, your earnings are going to be depressed, and that puts the community banks in a process where they're going to be working out of that situation for a number of years to come. So I think the regulatory reform, if it can help the systemic risk and if it can help us from going through another sharp downturn like this, will indirectly benefit the local banks. But the direct effects won't be so catastrophic or negative for the local banks. It'll be something they'll be able to navigate and deal their way through. And with that, I'd like to wrap up that part of the presentation and turn it back over to Shri to introduce our next speaker.
Thank you so much, Harvey. That was, really sets us up for the next. I'd like to welcome Mr. Arthur C. Johnson. Who else better to come and talk to us about what's happening today with the proposed regulations for the banking industry, which is one of the most regulated industry. Art is actually currently the American Banker Association chairman at this time, and also is the chairman and CEO of United Bank of Michigan. He was named the Michigan Banker of the Year in year 2000, spends a lot of times commuting between DC and here, trying to appear before the House and Senate committees, giving the ABA's perspective about the concerns and issues on proposed regulation. So without any fail, I would like to hear what you have to say, Art. Again, the floor is yours.
Thank you very much, and good morning. I'd like to move through just a few slides fairly quickly to give a little background and a little factual matter upon which we can base our further discussions when we get into the Q&A discussion. I think it's I have a rather unique opportunity this year as chairman of the American Bankers Association, and being a banker from West Michigan, from Grand Rapids right here, because Michigan does have a bit of a different perspective than does either New York or Washington, D.C. We are outside the Beltway and we are west of the Hudson, and it's a perspective that I think is valuable. So, moving right into my slides. On the first slide, we're trying to show here that over time, since in the last 4 or 5 decades, the amount of credit availability has grown dramatically, but much of that growth has been outside of being provided by insured depository institutions. Banking credit, while it has grown, the most dramatic growth has been in other financial institutions that are not nearly as heavily regulated as traditional banks. And you can see that the percentage peaked and has fallen off fairly consistently from the mid-70s to today. On the next slide, we can take a more specific look over the last 10 years or so in residential mortgages. The green loans are the traditional mortgage that are well underwritten, where there is a down payment and where there is some equity from the very beginning on behalf of the borrower, and the borrower actually has to prove that they're able to repay the loan from their current income. You can see that much of the growth has been in the Alt-A and subprime market during the latter half of the last decade, but that came to a screeching halt in 2008 and 2009, and actually in 2009 the traditional mortgage business was really the second best year ever for many banks, including our own right here in Grand Rapids, second only to 2003. So the mortgage business is alive and well. It is just back on a more traditional footing. On the next slide, let's take a little look at what are, from a banker's perspective, this is what's happened to collateral values. In looking at both the Case-Shiller index, which is the red line, housing values have fallen off rather dramatically since their peak in 2006, off about 33%. The real interesting part of this graph to me is the period in 2007 and 8 where residential values were falling but commercial real estate values were still increasing. I'm not sure I understand why that was happening, but it was. Reality did catch up with commercial real estate values as well, and they fell rather precipitously over the last couple of years. Both markets have upticked just a little bit. I think it's maybe a little too early to call that a floor, but it could be a floor. We'll just have to wait and see. On the next slide, here's the rather dismal news for many banks. What is happening to our delinquency rates on our loans, different kinds of loans, commercial and industrial. The big one is construction loans. That shouldn't be any surprise to anyone here in West Michigan or in many, many other parts of the country. 1 to 4 residential at very high historic levels. But the one thing that I think it is useful to look at in this graph is that if you look what was happening back in the early 90s, these rates do fall. And we believe that when jobs pick up and when our economy starts to recover, that these non-current rates will fall rather precipitously as well. We just have to get to that point. On the next slide, a little bit about the state of the banking industry, the insured depositories part of the traditional banking industry. You can see that they are the number of problem assets and the number of problem banks has risen rather dramatically in the last couple of years, but you can also see that the number is substantially lower than it was during the early 90s. And and what this tells you is that banks were actually quite well capitalized coming into this crisis in general. I mean, it's not every bank, but the system-wide, we were quite well capitalized. And while it is no fun in our industry right now with the number of troubled banks, I expect there was a substantial number of banks closings, smaller bank closings in 2009. I would not be at all surprised. In fact, I would expect that that number will be up slightly in 2010. But we will recover when the non-current loan rate begin to diminish. The problem banks will diminish as well. So it's not as if I think, as Dan mentioned, it's not as if we have been able to outlaw the business cycle. It was just delayed for a little bit, and it's perhaps not an entirely bad thing for there to be corrections from time to time. Just this bigger correction is a little bit more problematic. And with that, I'll be ready to engage in our discussion when we get to that part of the program.
Thank you very much, Art. Last but not least, we have Mr. Ron Kruszewski. Mr. Kruszewski is the chairman of the board and the CEO of Stifel Financial Corp. and Stifel Nicholas. Mr. Kruszewski has been in the industry and been with Stifel since 1997. He has been in the investment industry for a very long period of time, and he's also is in the committee for Securities and Financial Market Association, and he's very heavily involved with the community in St. Louis, which is where they're based out of. And I thought it would be very interesting to hear from Mr. Kruszewski on the non-financial banking institutions. They're being part of the crisis they have suffered through, and so we have both the banker and a non-banker, and without fail. And Ron wanted to make sure we're not going to be on the web so that he will temper his comments and not be as candid. No, Ron, it'll be a pleasure to hear from you, so the floor is yours.
Thank you. Good morning. I noticed, I said this morning at breakfast, we have a professor, a lawyer, and a banker, and an investment banker, so I know who the villain of this panel is, which wasn't true. What I'd like to do is talk about, flip these slides really quick. My agenda here is what happened, how do we fix it, and let's not forget our fiscal responsibility. What happened, flip again. I think Art said it, and Warren Buffett said it better. Warren Buffett made a comment that leverage is easy to put on and not so easy to take off. And what you saw in many cases, and you can talk a lot about what happened here or there, but the fundamental, in my opinion, root cause of the crisis was the incorrect belief that housing prices in the United States and frankly around the world would continue to go up 5, 6, 7% a year. And you couple that with a financial services industry that became very deregulated and was allowed to leverage itself to an extreme measure against an asset that was always thought to go up. And as my kids would say, duh, when the asset values decline and you have loans, it's a difficult situation. So what I call happening, and what happened was called pass the trash. It's sort of like the children's game of musical chairs. And I'll address, before I go through this slide real quick, that a lot of the solutions that we're talking about today in Washington is typical Washington rhetoric. In that many of the things, and you will find out through my comments, that I'm not a firm believer that the federal government can either be an effective watchdog in terms of saying that some regulatory agency is going to be able to predict where the next bubble occurs. I find that almost at the height of absurdity. They should run a hedge fund, and when they find the bubble shorted, they're certainly not going to predict. It's the old adage that when you're inside a bubble, you don't know it. So to think that our government is going to prevent the next bubble, just go back to the 1400s with the historians with the tulip bulbs, and I can pick every bubble that's going to happen, and we will have another one. The question is what's going to happen. What happened here in this Consumer Financial Protection Agency, again, is ridiculous. They want to protect you from being able to get a subprime mortgage. Try to go get one. It's impossible. And the reason you can't get it is it never made sense in the first place. It was a dumb loan. The reason it was able to get done was because it was a game of pass the trash. And so let me show you what happened. You start with the assumption of prices up forever. You get a mortgage lender who's sitting here saying, hey, he really has no skin in the game, but the mortgage lender is out there doing no income, negative amortization loans. Again, you can't get these today, they're over. Because the reason it was able to get done is the mortgage lender handed it to the bank, so the trash got put to the bank. Enter my industry, which is Wall Street, and you could securitize this. What that really meant, securitization simply is that you could leverage this. Leverage it 20, 30, 40, 50 to 1. And so it was this huge demand for crappy loans that you could get securitized. And then a very important piece of the chain was that the rating agencies put their stamp of approval on it. This is very key, because without the rating agencies stamping this stuff, which was trash, AAA, you could have never sold it to the unsuspecting investor who was sitting there going, well, wait a minute, I got a AAA security. Well, he didn't have a AAA security. But remember, when we talk about trying to reform our financial services industry, this problem is not going to occur again. It's just not, because there are no buyers for this stuff, because they got their heads handed to them. So you're not going to go out and buy a subprime securitization circa 2010. It doesn't exist. Art's slide showed it, that all traditional mortgages today are traditional mortgages. But then what happened? When the unsuspecting investor actually just gave it back to the government, who then just gave it right back to you. So pass the trash ended up coming back right back to the taxpayer. And we need to be thinking about what it is that prevents the game of pass the trash, because in the end, an unregulated, over-levered financial system, which was allowed to have absolutely no skin, just pass the trash, pass it all the way back to the U.S. taxpayer, which in Missouri, they're pretty mad. The taxpayers don't like the fact that my industry has some proverbial safety net underneath it. And that banks were not allowed to fail. So I think that that's a simple way to explain, I think, what happened in Pass the Trash. If you look at it then, who would have thought that AIG, Fannie and Freddie, the perfect example of never-ending home prices going up, are now wards of the state, along with AIG, Citigroup, Lehman Brothers, gone, Bear Stearns gone, Merrill Lynch into a forced marriage with Bank of America. If you'd have told me that this was going to occur at the beginning of 2008, I'd have sold my business, moved to somewhere, some island, because it was financial Armageddon, what we went through. So what you have to do sometimes, I had a video clip that doesn't run, but I said sometimes you just have to step back and ask if the model makes sense. And I will offer that we also need to step back and talk about whether or not the proposals that are being put forth in Washington effectively make sense. Do they make sense? I think in many cases they are looking in the rearview mirror as to what can happen. And there's some things that we have to do. So how do we fix it? Well, I think first of all, you have to fix the foundation of this. So in the adage I always think about is that they said we're going to have the systemic risk regulator, right? And my view of it is that what you're going to have is a bunch of people watching the Leaning Tower of Pisa, all right? They're going to watch it, okay, and eventually it'll topple. You can watch it all you want because the foundation is not fixed. We need to fix the foundation of our financial system, and it's going to be done through policy, not necessarily regulation, not necessarily creating all these regulatory bodies. You have to think about policy. So the first is, and these are very, very difficult policy decisions that we have in the United States, but the first is simply, and no one's going to argue about this, but the devil's in the details, you have to eliminate too big to fail. We live in the best economy, capitalist country in the world, but if you take a business and you fail, you fail. You do not have a taxpayer bailout. If you're too big to fail, you're too big to exist. And I would submit to you that too big to fail in the financial services industry is akin to monopolies and commerce. And think about it. We have laws that do not allow monopolies to occur in commerce. But we turn our back on too big to fail in many ways and allow these institutions to become too big. It distorts pricing, it does a number of things. So what happened in 1890 to the historian, right? 1890, the trust companies got too big. We broke them up. I guarantee you Rockefeller stomped and screamed all the way when they broke up the trust companies in 1890. In 1929, we put in Glass-Steagall. 1984, we broke up the biggest monopoly in the world at the time, AT&T. That breakup led to the biggest telecommunications boom and innovation you've ever seen. So I would submit to you that too big to fail is something we need to deal with. It makes no sense as people here to take two institutions that are too big to fail and then combine them, as we did, Merrill Lynch and Bank of America, combine them, put our heads in the sand and say this isn't going to happen again. A lot of things we can do, capital levels, a number of things, but we need to do that. Second, address derivatives. Derivatives are a very profitable vehicle for my industry. Make no mistake about it. Derivatives are also weapons of mass destruction in financial institutions because they're overly leveraged, unregulated instruments. The best trade that you can make in 2008, we get together and we, it'll lead to my next point, we short a stock, and then we go and we buy a credit default swap, meaning that we're betting that the value of a company's bonds are going to go down. Then we trade it between ourselves because there's no exchange, and we trade it to make it look like the company's in trouble. We're short the stock, and we talk about it, and then next thing you know, the market, it was huge manipulation that went on in an unregulated market. So that needs to be fixed. Derivatives need to be centrally cleared. I'm not so sure about trading them because they are one-off, but they need to be centrally cleared. We need to learn from our past mistakes. Our industry got in a lot of trouble in the 60s because we did not centrally control risk. Today, you all as taxpayers need to ask yourself how a small group of traders in Connecticut at AIG almost brought down the financial system. And they did because no one knew the risks they were taking. No one knew. Put it on a central clearing, you'll be able to monitor counterparty risk. Enforce short sale rules. These are simple policy decisions. All of it, the CFA, Ted, I would tell you, we have all these rules on the long side. If you go long 5%, you have to disclose your long positions. You have to do all of this in my industry. Short sales, you don't have to disclose anything. You should have to disclose your short sales just like the longs have to do. The light is the best disinfectant to any problem, and short sales is a big problem. And then finally, on doing this, pro-cyclical regulation. What I mean by that is many of our policies and many of our accounting rules exasperate problems. So we did not allow banks, for instance, to set up loan loss reserves during good times. We said, oh, geez, they're smoothing earnings because the banks used to set up loan loss reserves knowing that the downturn was going to come. We eliminated that, and then what happens? The banks get in trouble. They have to accelerate loan loss reserves. Then they need to go raise capital. And our own accounting and our regulation rules exasperate the problems. We have to fix pro-cyclical regulation. And then finally, I think that for our kids' sake, we need to apply what I would call appropriate stimulus. And I think this is very important that we do this. And if you go to the next slide, when I say let's not forget our fiscal responsibility, let's not forget our fiscal responsibility to our children. And if you look at this, the old stimulus programs made sense to me. And it's old Keynesian economics where when the government stepped in, you built the Hoover Dam, you did the Tennessee Valley Authority, you did the Triborough Bridge, you did the Lincoln Tunnel. Heck, we did the Eisenhower project to build all the expressways. But the reason that made sense was because those were effective investments in infrastructure in the United States. There was actually a return on investment. And with a return on investment, you can build the GDP of the country. But where we're going is anything but that. If you look at even TARP and the federal bailout programs, and these numbers are staggering to me, it's the next slide, we've spent $3 trillion on TARP, AIG, asset guarantee, yada, 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 and there's another $11 trillion committed. $1 trillion. So what is our concern, and what am I most worried about? I'm really not that worried about the government and the bill and all of that stuff. It's probably going to be ineffective anyway. What I'm really worried about is the fact that the United States does not turn into Japan. And that will show this last slide. And what happened, and it's a very complicated slide, but it makes a point, and that is Japan in 1995 ran 93% debt to GDP. And what they did was effectively spend money building monuments. What I mean is they've spent money ineffectively. And there was no return on investment in Japan's investment. And today, Japan runs 219% debt to GDP because of the fact that the government basically spent money unwisely. We as taxpayers owe it to our children not to do that. We need to be accountable that money spent and deficits spent should be run like a business. You should have a return on investment. The only real effective way to do that is to put stimulus dollars in the hands of entrepreneurs, not centralized government handouts, which in effect will result in fiscal debt going out of control. 2020, our interest on our federal debt is projected to be $1 trillion. Our kids should shoot us. Thank you.
Thank you very much, Ron. On that note, we're going to go to the Q&A session. We have a couple of our student aides that are coming with cards, so if you have any questions, please write them down and pass it on to us. It'll be great. But I'm going to start off with a question, Ron. Since the last slide was with regard comparing Japan versus the USA, the point was made that how a financial crisis led to the real assets going down value and how that is affecting the real economy. In your opinion, then, what would be the best way for us to get the real economy going, given all the new programs that are out there? How do we translate from, because that's going to be critical for us to start seeing the real asset values going back up. So what would be your comments to the government saying, how can we get the real economy going?
Well, I think the first thing you have to recognize is that there is no magic bullet. And so the government, in many ways, first of all, TARP was needed. I'm not against TARP. I'm against the next TARP, not the past TARP, because it was needed. But the answer really is that we have to recognize as an economy and a society and business that we were, crazy with leverage. And an over-levered economy takes time and is somewhat painful to come out of. But the extent that you try to alleviate that pain by throwing dollars at it, which is what we're trying to do, we're trying to repeal the business cycle, will make we're just kicking the problem down the road. So I think that what you have to do is no different than if you're at home and if you go out to dinner all the time and run your credit cards up to the point that you can't go to dinner anymore, you can't go to dinner. You got to pay down your credit card debt. And we as a country have to do the same thing. It's really not that difficult. Real asset values will rebound when the debt leverage gets back in line. And not until then. There's nothing you can do about it.
Okay, thank you. Art, the next question, too big to fail or too systemic to fail. Now we have different names for it. At the end of the day, those are referring to institutions that we seem to have a very difficult time allowing them to fail. Under the proposed rules, there are different proposals on how we can have some contingent capital or new resolution authority. As part of the ABA, you face the difficulty representing the large and the small banks. What has been your perspective or the ABA's perspective with regard to how do we deal with these institutions that are too big to fail or too systemic to fail?
Well, this happens to be one of the subjects where banks within the ABA are pretty much in agreement that we do want to end too big to fail, and this includes the very largest institutions. There is definitely a need for a systemic resolution authority, but the devil, as Ron said, the devil's in the details. I think everybody agrees that ending too big to fail is a good idea, but how do we get there? The position that our association takes, and one that I agree with, is that we have to be very careful. First of all, Ron mentioned this a little bit about there are accounting rules here, and that plays into this to some degree. But what we need to do is to be able to monitor, but not, and have a resolution authority that, with predetermined rules that are some combination of what the FDIC does with bank closures and what bankruptcy code does. And I don't think running these large banks through the bankruptcy proceedings, we learned with Lehman Brothers that that's not a good idea. But there do have to be established principles so that creditors and the entire marketplace knows what the rules are for these large institutions, knows how they will be treated, and then they all have to be treated that way. There's a lot of discussion right now as to whether the FDIC should be that authority, and giving them a lot of flexibility. I think the right answer is, and this is hard to get to, is to give them some flexibility, but not too much, because an easy solution would be to just dump more money into them. And that wouldn't be the right thing to do.
Any follow-up comments on that, Ron, or anyone else?
You know, Art, I will say that I just want to comment that, and I had a lot of friends at Lehman Brothers, a lot of friends. So this isn't easy for me to say, but I think I'm in the minority where I believe that Lehman Brothers should have been allowed to fail, and they did allow to fail, and it was very painful for the for the whole industry. But we got through it. And what happened when Lehman Brothers failed? We found a problem in our money market system, in the fact that that the moral hazard that you would not allow a Lehman Brothers to fail caused the reserve fund to break the buck, which was a very traumatic, and it was dark days. But what happened because of that failure, our financial system got stronger because the money market funds realized that they couldn't do that anymore. So bankruptcy and failure is a necessary component of capitalism. And I think you're saying that, but I think that we should all ask ourselves in Too Big to Fail, whatever resolution authority we come up with, can we run Bank of America through it? I mean, can we run it through it without taxpayer assistance? And if you can't answer that question, then you better keep working on policy.
Good question. Harvey, one of the things that's been brought about in raising new capital is part of the problem we saw in the crisis is that capital was scarce. We wanted the banks to raise more capital. The only thing they can do was to have a fire sale of some of the assets to raise the capital that was required. Now, you know, and that obviously led to even more depression in the prices of the real assets. It's a vicious system. So the question here is that, you know, how do we in the next crisis, as Dan has indicated, we know it is going to be coming sometime or the other. The question is if and when. And you know, what are some changes we would like to see in the reforms that would allow us to focus more on raising capital, but not necessarily on getting rid of the assets when we already have depressed asset prices?
Right, that reminds me of a conversation I had with a banker once who explained to me, well, Harvey, the way the system works, you can't have too much capital because then you'll never have enough return on your equity and you'll never have enough earnings per share. So you don't want to be the bank that's super well capitalized, yet you don't want to be too far down either. You've got to manage it right in the middle. Even short of government regulation, I think we as investors and as the investment community need to rethink risk and allow for banks to retain additional capital, to build up capital during the good times so that they're able to better withstand the bad times. Because otherwise we get ourselves in the pickle where we are today, which is where there wasn't enough capital to survive the huge, or to manage the huge downturn well, and now the institutions are so hurting that investors are afraid to put new capital in. So I don't know that it's so, there are regulatory aspects to that. I think the SEC went overboard in the whole managed earnings business and needs to allow institutions to add more capital when they need to, and I think the regulators have to rethink the ratios as well in terms of what's an appropriate level of capital, not just for banks, but also for non-bank institutions like the investment banks that got up to a 30-to-1 ratio. So it really comes down to both fiscal responsibility in the investing community and an understanding of risk, and also appropriate regulatory changes.
Thank you. Dan, that comes naturally to you. I'm sure you follow a lot of blogs, and we're talking about one of the articles, columns by Krugman yesterday on New York Times, talking about the leverage ratio and this, as you look at the shadow banking and more the non-banking, not traditional banking that has been played a significant role in the crisis. What suggestions do you have so that we don't, the history doesn't repeat itself, and where should we focus as far as regulation is concerned?
Yeah, I think one thing that sort of would be interesting to keep in mind is that if something, walks like a duck and looks like a duck and quacks like a duck, and I think if, something looks like a bank and if they basically, they acquire, long-term assets through short-term financing, they're a bank basically, or at least they work like it. And so I think the regulations, they should be brought inside the regulations. I think that's one of the things. The traditional banking sector in general still did all right through this, but it was the investment banking side that was sort of this unregulated side that didn't work as well. So I think the regulation needs to be quite a bit more encompassing in what it looks at. So that would be my main thing to keep in mind.
Great. Thank you. Ron, this is a close question from the floor. Today's Wall Street Journal says that Wall Street employees received a record $140 billion in 2009. Where did that money come from? That is, how did they earn that amount in a down economy? I'm not trying to make you the bad guy, so I'm just trying to get your perspective.
How do we make so much money? Is that the question?
Uh-huh.
In many ways, and I think it's a problem with the industry, the industry lost so much money on mark-to-market. It was, they just had to mark those assets down, and the rebound created a lot of earnings. The real question, and I think the controversy in the industry, is that no one should criticize any entrepreneur or anyone in business who risks capital and makes money. I don't. If anyone disagrees with that, I think you should move to France. But but if you get bailed out by the government, okay, where I went to school, that means you failed, and then to pay exorbitant amounts of compensation when the taxpayers bailed you out is to me almost irresponsible to our system. And so I think the outrage comes from my mom, who asked me, and she doesn't like what I do for a living. She says, what social good do you do? And I say, I create jobs, I think, Mom, but it doesn't matter. She doesn't like it. But the point is that if you've taken a government bailout, as she says, then how do you pay yourself that much money? That's wrong, and I'm not going to defend it.
Okay, great, thank you. The follow-up on one of the comments that you made was mark-to-market, and I'd like to hear both Art and Harvey pitch into that also. Is that how much of mark-to-market has contributed to the crisis, and what do you hear from the industry and especially the bankers and the non-bankers that have had to deal with the issue? Because I do have an accounting friend sitting over here, John Chisholm, but so I'm kind of curious to hear about the mark-to-market and how much of a role that has played. So.
Well, I think it's a huge problem. One of the early one of the discussion points is what can we do to raise more capital for the industry. I think really the first question is what can we do to stop eliminating capital that we don't need to eliminate from bank balance sheets. And mark-to-market has not proven to work in a dysfunctional marketplace, when collateral values are falling precipitously, when regulators are coming in and looking at loans that are performing. The businesses may be under some duress, but they're still making their payments, but simply because the collateral value is down, banks are having to write down the value of those assets and are having to mark them to an exit price when it's a very fundamental economic fact that it takes a very, very small variance between supply and demand to to have a huge impact on price. And when there are lots of sellers and no buyers, it is going to have a mammoth impact on price. And that has happened on virtually every asset on every balance sheet of every business. And particularly for the financial firms, which are by their nature more leveraged than industrial firms, it's had a profound impact on the capital accounts and really made this problem much, much more worse than it needed to be. Now, it was going to be a problem. There's no question about that, but a much bigger problem than it needed to be.
Any follow-up on?
No, I think I'd defer to the other panelists on mark-to-market accounting. I don't know if Ron or Dan, you have anything you want to add to that?
Well, if you make a loan if I make a loan in St. Louis to someone that I know that it's a good loan, and I go try to sell it in New York the next day, I'm not going to get par. I'm going to get something less than par. And so, in many ways, the mark-to-market, while makes sense from an accounting perspective, mark-to-market in banking in terms of making loans that you expect to perform and repay is just adding fuel to the fire of trying to run an effective banking system. So I agree with you, Bart, and then that's pro-cyclical regulation. You're required to mark the assets down when the fire is occurring. And then now you have to raise capital to handle the mark, and it's a downward spiral. Very difficult.
Thank you. The next question is for Art, and then I'd like to hear Harvey also pitch in. Michigan banks to the auto industry, should the Michigan banks receive more assistance from the Obama plan due to the auto industry decline? Your thoughts, your feelings about the situation with the Michigan banking industry?
Well, it's kind of a complicated issue, and let me approach it from this perspective. In order for our economy to recover more broadly, but certainly in Michigan, credit will be required to do that. When businesses decide that they want to, that they have some orders coming in, and they want to add some people, and they want to add tools of production to create jobs, they will need credit to be able to do that. That credit is going to have to come from banks in Michigan, because I think it's fair to assume that Michigan is going to lag the general recovery, and frankly, sources of capital that are not based here in Michigan are frankly going to be deployed elsewhere, more likely than not. So having a well-capitalized banking system in Michigan will be critical to our ability to recover. So I would be loath to eliminate any possibilities in terms of making that possible. There has been a idea promoted by the Obama administration to take $30 billion of the repaid TARP money and make that broadly available to the banking system for capital injections. One of the problems for non-Wall Street traditional banks in round one of TARP was that it was not communicated very well to banks. A lot of us were told that it was our patriotic duty to accept TARP funds, only to then be later demonized by public officials and the press and the public for having taken that. My bank did not take any TARP funds, even though we did qualify. We did apply and were approved, but decided we didn't need the money, which was a correct decision, as it turns out. But there would be, first of all, then, how are we going to administer this program? How are we going to determine which banks will qualify and which won't? In the first round of TARP, you had to qualify, whatever that meant, for the capital before you got the capital, which means if you really needed it, you didn't get it. That didn't seem to make any sense to a lot of people. I haven't really heard what they plan on round two, but it seems to me you should need to qualify after you have the capital to be a surviving institution. Would be a more logical test. I can tell you that an awful lot of banks that are surviving, not thriving, but are doing just fine and will survive, that may be able to deploy additional capital when we start having a recovery, but would refuse it if it had anything to do with TARP simply because of the taint that would be attached to it. And so calling it TARP 2 or even earmarking the money as having come from TARP, I think would turn off a lot of potential participants.
Yeah, I'll add a couple of things to that. As you all know, we've had it tougher for longer in Michigan than most states have. One silver lining of that is our banks have had it tougher for longer, and although we've had a couple of failures here and there, in terms of sheer number of bank failures, we don't have nearly as many as Georgia and California and Florida and Arizona and states that went through more of a boom and bust with a housing cycle. I think the thing that really wreaks havoc with the industry long term, and any industry, is to have these huge swings in the economy. And one of the shortfalls you see in all this regulatory reform is if you're a politician, you're always looking for a villain, whether it's investment bankers or people who securitize mortgages. You're always looking for somebody else to blame for the problem. What you don't see is a lot of hard introspection by the government into their own fiscal policies. You know, you look at, does it make sense to have Fannie Mae and Freddie Mac and the federal government somehow involved in half of the mortgages that occur in this country? I mean, do we really want the federal government subsidizing and pumping that whole industry up only to have it come down later? So, you know, you have all these programs that are short-term fixes, but the long-term answer is a more steady, sane national policy in terms of our debt and what the government is and is not involved in. And I would echo Art's concern that if you're going to have a program to pump in capital, there's something perverse about not giving it to the people who are the sickest and could survive with a little extra capital along the way, and instead potentially have the FDIC come in and resolve the institution when the FDIC spends about 40% of assets on an institution to get it resolved if the institution goes down. So better fiscal policy is a better answer.
Okay, thank you. On that note, next question we have from the audience is with regard to the FDIC. I know we have had liquidity needs and special assessment from the FDIC, and I'm sure Arts bankers have called him. How do you know how to view FDIC's liquidity needs and future obligations from bank failures? Who will pay for FDIC problems, small banks, large banks, et cetera? Do you expect FDIC insurance for businesses for deposits over $250K?
Well, that sounds like it's for me. I can tell you who pays for it. The FDIC is ultimately a industry-funded corporation. We pay insurance premiums, and let me tell you, they went up a whole lot this year. It is far and away one of the largest expense items on our income statement. The FDIC, you should not worry about them having access to monies to be able to resolve all the banks that need to be resolved. They've put, actually we had to make a 5-year prepaid premium payment this past year, which was a real big check. We don't get to deduct it all in this year. FDIC and the IRS are not working exactly on the same page for us there.
It's your government at work.
So there, and the FDIC has a very large multi-billion-dollar line of credit from the Treasury, which they have not used in this particular crisis. And the current chairman, Chairman Baer, is very committed to not using that. One could argue that it might have been better, because when When we make a large prepaid expense item, that comes out of our capital account, which diminishes our ability to lend into the economic recovery. So one could argue that perhaps she should have been more willing to use the Treasury's money, but I'm going to defer to her on that, but because that still is a backstop that's available. So I don't think we really need to be concerned about whether the FDIC has access to sufficient funds to be able to resolve all the banks that need to be resolved. While I mentioned earlier that there will probably be an increase in banks failing this year over last year, and I think it'll start to tail off after that. These will be small banks, and while it will be very catastrophic for those banks and it will be very difficult for those communities, it's really not it's not going to be a big thing in terms of as it relates to prior problems, the S&L crisis and so forth. It's not going to be as problematic as that in terms of the FDIC's ability to be able to resolve those institutions.
Okay. Just a quick follow-up, Art. I know with the, is there any chance that we may have a differential assessment that may come between small and large banks given the risk? And secondly, and I think this crisis kind of put into light, still we have an assessment that's largely based on the asset quality, is that the quality of the liabilities will become an issue or significant component of figuring out the assessment?
You know, I'm not real sure exactly how we would get around assessing. I mean, you can make this too complicated at some point, and it's already reasonably complicated. There is a quality assessment right now that is it's relatively heavily it's based on our CAMELS ratings, which is what the ratings that we get after a rigorous on-site examination, which occurs in banks at least every 18 months. I can't say that we always agree with how those assessments come out, but it's a very rigorous process. And so there is already a risk-based component to our premiums, and liabilities and how you are funded is a component of that. Now, on the issue of whether the assessment base should be based upon deposits or total assets, I'm inclined to think that it should stay on deposits. Now, there is a lot of discussion about, well, that penalizes small banks vis-a-vis large banks, and that's not really true. It may tend to be that way a little bit, but size is not the determinant. The funding structure of your balance sheet is what is the determinant there, and if you are if you rely very heavily on insured core deposits, then you know it's going to be different than if you are a more wholesale funded type of organization, and that is not strictly determined by size.
Okay. All right, thank you. Ron, here's a question for you. How do you enforce good policy without regulation? And I figured that's something that your industry has always looked at. How can we enforce and govern ourselves? And so maybe you can give your thoughts about going forward.
Well, first of all, you do need regulation. I'm not a proponent that you don't need regulation. You need, in many ways, you need principle-based rules versus strict rules. Strict rules allow you to get around them, and people maneuver around them. Principle-based rules are more safety and soundness. There's some basic tenets in financial institutions that make sense, and in the end, it requires that it's not other people's money, so that you're not out there with other people's money speculating. You need a stake in the game, And, and you need organizations that, in many ways, follow the golden rule. And you cannot regulate morality. You can't regulate good business practices. The market should do that. I think it's incumbent upon managements to do that. So, but I don't believe in government intervention at all. I'll go back to one of the questions. I grew up in Paw Paw, Michigan, so I don't live in Michigan anymore, but $30 billion, we should all be cautious about any time the government's going to invest directly into private enterprises. I frankly wish they'd have invested in Anheuser-Busch. We lost, they could be a beer shareholder in St. Louis. We lost them to InBev, the Dutch, but the answer to these problems is not and cannot in our country, if we're going to be as great in the next 100 years as we have been in the past 100 years, the answer does not lie in government, taxpayer investment in private capital industries, whether it's the auto industry, the beer industry, or the investment banks. And I think that we need to be very cautious about that.
Thank you, Ron. I know I promised these gentlemen we'll be out of here at 9:30, so right now what I'd like to do is to have closing thoughts. I know we didn't get to all the questions, and there are a lot of other issues. The speakers may be available for a few minutes after this, but right now I'd like to have the closing thoughts from each of our speakers, and then we'll end our session for this morning. So,
Yeah, I guess what I'd like to close with is to kind of follow up on a comment that Ron made earlier about, maybe Lehman Brothers failing was sort of a good sign because it sent a good signal that these firms could fail. I think it maybe sent the opposite signal that they realize now, the largest financial firms, to realize that the government's never going to let that fail. So now they can do whatever they want because they know they're going to get bailed out because they saw what happened. So the reserve fund, that kind of sanctioned a little bit, but I think overall we talked about the mergers. So I think the comments that were made on your side of the table, too big to fail means too big to exist. I really think that's a pretty important regulation. Maybe you don't necessarily have to completely destroy them, but one way you could get put that in place is through some sort of progressive tax. If you get bigger and bigger, you have to pay a higher and higher, almost like an insurance premium. The more systemic risk you introduce into the industry, then you're going to pay a larger and larger premium for that, as opposed to just saying once you reach a certain size. If you would just want to put it on a strict size basis, then maybe on a percent of GDP. That might be a way to do it. And that way, as the economy gets larger and larger, you can have the firms grow with it to still provide financing. So I guess that's where my closing comments.
all right, thanks, Dan. Harvey?
The only thing I'd add is that in America, it's fun to blame the politicians and complain about the government policies and the programs and everything. But one thing politicians do very well is they have their finger on the pulse of what people want and what people are willing to accept. So I think there's a certain responsibility on all of us to be willing to make the tough decisions, to live with the tougher policies, to show the restraint, to do what we need to do and send that message to our elected representatives so they have the cover to do what needs to be done rather than just take the easy short-term way out every time.
I guess my closing comment would be that we've talked a lot about a lot of things here. We've talked about too big to fail. We've talked about mark-to-market. We've talked about transparency. We've talked a little bit about consumer protections. And I think kind of in keeping with Harvey's comment, the important thing here is to make sure from a public policy perspective that we don't just get an easy fix, but a fix that works and is aimed at the right target. That, unfortunately, I think is not the case on much of what's being discussed right now. We need to get those big guns turned around and aimed at the right targets.
I think I frankly agree with all the panelists. I think you have to, we've just gone through the biggest financial crisis, certainly in generations, generational crisis. And at this point, we have failed to do anything to put policies in place to try to mitigate or prevent that again. I am for regulation, for good regulation, smart regulation, and I would just leave with the thought that we need to make sure that we're thoughtful because if we don't address it, as I said at breakfast this morning, there's not enough TARP money in the universe to deal with this if it happens again, because we've just created a bigger systemic issue today. And today, as we sit here today, we've actually done nothing at all to deal with the financial crisis we just went through. And again, I think that's somewhat irresponsible on all of us, politicians, industry, business executives.
Thank you. Before we close out today, I have a small gift to show our hospitality to each of our panel members here. So.
Thank you very much.
We are from Michigan, so we make sure we have blankets here, so.
Thank you.
Thank you.
Ladies and gentlemen, would you please join me in thanking all our panel speakers for coming in today? So.
Good.